Welcome to CFO 4.0, the future of finance. The CFO role is changing rapidly, moving from cost controller to strategic visionary. And with every change comes opportunity. We are here to help you take advantage of this transition, to win at work, drive your career forwards, and lead with confidence. Join Hannah Munro, Managing Director of ITAS, a financial transformation consultancy, as she interviews key experts to give you real-world advice and guidance on how to transform your processes, people, and data. Welcome to CFO 4.0, the future of finance.
So hello everybody and welcome to this episode of CFO 4.0. I'm very excited to say we have our returning CFO coach on the show again today. And I almost set him off before I started this podcast and he was already getting into topics. So so as always, really excited to have Mr. Jeremy Earnshaw on to talk to us and to continue our conversation on mergers and acquisitions. So, welcome, Jeremy. Thank you for coming back onto the show.
Thank you, Hannah. A pleasure as usual. Yeah, happy to offer any kind of guidance that I can. So thank you for the invitation again.
Well, today we're going to focus more. We talked a lot about acquisitions and doing the acquiring. I think today we're really going to try and hone in on how do you effectively guide a business through a disposal, so being acquired. So let's just start with that first point. I'm going to ask the question: how do you know that you're in a good position to be acquired or to dispose of the company? What are some of the things that you need to think about?
I'd probably turn it around actually, Hannah, and think about if you as a management team are almost exclusively focusing upon being acquired, planning an exit, probably got that the wrong way round. Because
Mm,
if your business is doing really well, and if it's in an attractive sector, and it's got good history,
yeah.
I'm pretty certain that people would be finding you as a buyer. So I think some of the things that it's always useful to have, I think, in your armory would be to be ready to present information in a format that doesn't take 6 or 9 months to compile. And if you're able to do that, I think number one, it's an element of credibility. If people are asking you for information in a format, maybe you have to reformat some of that information. But if you're able to give that information reasonably quickly to a potential buyer, um, it gives some credibility to you as a management team. If it's information that can be easily interpreted, so it doesn't take a genius to understand exactly what's happening in your business. So without necessarily having a ready to print investor memorandum to give to potential buyers, I think all just being in that position of thinking as as a manager really as well, to think about am I understanding what's happening in my business? Am I able to, if somebody talked to me outside of the organization and said, what's your business model? Why is it competitive? What do your competitors do that you don't do, and vice versa? If you're in that position that you're able to respond on that fairly quickly, I think that will transfer to the potential buyer as well and give some credibility to a potential purchaser.
And I think that's a really good important point about, are you looking for a purchaser or are you is a purchaser finding you? So, what's your view on that? Like, are you do you when you've been in that position, have you proactively gone out to find buyers, or have you very much been given an opportunity and something's been brought to you?
Both, actually. And I've done a number of exits from the public company arena and in private companies as well. And I think on balance, I think it's better to be in a position where the buyer finds you. I've always
Mm,
found it quite frustrating to be in the middle of a process as a buyer where there is a perfectly reasonable advisor who's managing that process. And I guess it's a little bit about if you're trying to do a transaction with anybody, whether, for example, if you're buying or selling a house, I would
Mm.
much prefer to have, as I did with my own current house, this one, in fact, where I am, I engage with the buyer. I was able to do that one way or the other. I got a relationship with the in this case the seller, and I was able to establish that relationship. Just a little bit more difficult to do it when there's a third party involved, and maybe when the third party, through absolutely no fault of their own, is managing a process along particular tram lines and trying to create an auction and do their best for the seller, for example. So I think having the ability to deal with both of those. But if, as we said before, if your business is attractive and it's in a good sector and you have good quality information, not just financial information, but commercial information as well, it would be nice to think that potential acquirers would find you.
And how important, you mentioned obviously the auction approach, how important
Mm.
is it to have competition within that buyer selection process?
I've been in that situation, again, on both sides. And if I give you my practical example, when I've been a buyer and I've been involved in an auction process, and it's been effectively a sealed bid process to
Mm.
try and acquire an organization, my practical experience is that those have been the most challenging post acquisition as a buyer. And
Mm.
you've ended up thinking, I might have overpaid for this organization. Now, that's really not on the advisors, that's on us. So
Yeah.
if we allow ourselves as a buyer to be pushed into that situation, that's our fault. But you can get into a situation where if again, if we're thinking about the target and it fits the criteria, I know we spoke last time, is it on the strategy? Is it a business model that you want? Are you creating synergies? It can be quite easy to be lulled into that sense of maybe looking at things from a glass half full perspective than a glass half empty. And seeing it from both angles is pretty important, I think.
So on the flip side, is it better if you're being acquired or you're doing the disposal to be part of that process? Do you feel like you would get more out of it, or are there some hidden dangers of taking that, that multi-buyer approach to, for the sellers as well as the buyers?
I think as a seller, and particularly if it's a private company, I think you do need some good quality advice. And in fact, I'm actually coaching a client at the moment, who is a business owner who potentially is going to go into a process, and I'm coaching this organization rather than advising them. And I have advised them to get some very specific advice because I think they need to be in possession of information that, for example, uh, it could be a life-changing event for them. It could be the only life-changing event for them financially, and you'd like to think you're getting absolute maximum value for money for your organization if you're a seller. And your advisors should be able to tell you that. So if the market rate for your business is 3 or 4 times EBITDA, then I think I'd like to be in the possession of that information and make sure I get good value for money. Also, similarly, the kind of structures of deal, we've not even got into things like the tax implications and the legal implications, or whether you're doing a share for share exchange, for example, whether you're not taking cash on the deal, you're taking perhaps shares in another entity. I think an advisor can be really, really good value to show you the different kinds of compensation that you may receive for selling your organization. I think there's a real role for advisors, but ultimately it's about what you're going to do post being bought as well. Are you staying with the business? Does it matter what the culture is? Are you bothered, for example, about the culture if everybody in your organization is disappearing after the event? And it's probably not going to be like that. So even if you might be surplus to requirements post acquisition, your colleagues might not be. Might not be in that situation. They may be having to think about the way that they work within new organizations. So I think the culture is still important. The structure of the deal is incredibly important. Um, is it a bird in the hand versus two in the bush? Is it an earn-out deal, for example, which brings into the discussion all sorts of conversations about the accuracy of your forecasting? If you're potentially receiving remuneration and a sale price for your organization that's based on a forecast in 2 or 3 years' time. So all sorts of different kinds of deal structures, culture, the nature of the value. Is it cash? Is it shares? Is it a combination? And how long are you prepared to wait for full value for your organization? So just an unbelievable amount of things to consider if you're selling your business.
That's it. And I think, and when we're looking at, as CFOs and maybe guiding those business owners or those or the previous owners, like how do you make sure, is there anything that you should be doing as a CFO to make sure that you're seen, we talked about management information, but seen
Mm.
as I guess attractive to potential buyers? Is there what role does the CFO typically play in that that disposal cycle? Is it normally the realm of advisors, or does the CFO have a big role in that process?
My experience, Hannah, is that the CFO very commonly becomes, let's call it the point person in the organization. So although the CEO or the chair or the board might well have structured the deal, when it comes down to executing that transaction, more often than not, it's been me in that
Mhm.
situation. So having done any number of disposals, it's usually the CFO who, quite frankly, gets to have another job in doing
Mhm.
that. So in addition to the day job, you are managing a process whereby one misstep out of place can scupper the deal. So, for example, having real control over number one, any information that's imparted to a potential buyer. So, you as a CFO, I think, should be in control of any data that's given over to a buyer or the buyer's advisor. So, by doing that, for example, having a data room and almost treating it like a physical locked safe, and
Yep.
you as the CFO are in charge of who puts things into the safe and who gets things out of the safe. So you know exactly what information the buyer or the advisor has received, and it gets rid of any of those conversations, which is, well, you said that. No, I didn't. Well, there you are. There's the log of information. And you, of course, lots of people will know that you can get data rooms where you can actually check who's accessed it as well. So you can set up the level of access. You can set up the information that goes in there as well. And you talked about the information that actually gets transferred to a buyer as well. Leading up to a potential disposal or an exit may well start 3 years before, because one of the things that your buyer will ask you is, please show me your 3-year financial history. So having that in place and being able to, again, show it fairly quickly without having to recreate anything in a format that's easily readable. And the second question that may be asked by a buyer is, particularly if they're buying a business which has got potential forecasts for the future, whether the ultimate sale price is going to be based on that as an earnout or not, I would be asking as a buyer, as what's your credibility as a management team in terms of producing a budget or a forecast? So please show me how you have performed in the last 3 years in comparison to the budgets that you've set. So if you have a policy of setting very aggressive budgets, you need to have a story around that, because if you then very continually fail to meet those budgets, that will show up in your performance. So you'll end up with period 12 management accounts and statutory accounts where you've missed your budget. So if that's a policy, It might well be that you have two budgets. You have the aggressive one and the one that you expect to hit. Maybe the one that you run cash flows off in order to make investment decisions. And that may well need to start 2 or 3 years in advance of a planned exit or disposal procedure. So just getting everybody prepared in the last few weeks before going into a disposal process is unlikely to get everybody engaged. So, for example, and obviously there'll be confidentiality to a certain extent, but other people will need to be in that management team that's involved in understanding what's going on. And it may be that you need to consider lots of wider issues, particularly if you're doing international deals. I did deals in Germany, for example, where there was a workers' council. The workers' council had a veto on whether any transaction would actually take place. So we had to engage with the whole of the workforce and the whole of the workers' council in order for them to actually say, yes, we agree that this business is going to be acquired by you. And there's lots of other things. There's competition commission if it's a very big deal. There are other areas that buyers will wish to focus upon in due diligence, such as the commercial element. They would probably, as a buyer, try to want to understand the reaction of your customers. It may be that your customer likes you as an independent and doesn't necessarily want you to be acquired. So the reaction of your customers is something that you might have to take a decision
Mm.
to say, well, we will allow you to speak to our customers, or we don't allow you to speak to our customers before any transaction takes place. And that's incredibly sensitive.
And you mentioned there are ways that a deal can fall over, right? And we've hinted at due diligence in our past episodes, but where are the sorts of places where what does a typical due diligence process look like, and where can it fall over? How can you, as a CFO, prepare to take your organization through that?
Having a good relationship with whoever the other point person is, I think, is pretty crucial as well. Give you an
Mm.
example. When I was the CFO of a PLC, it's going back a few years, but I was the point person. It was a PLC. It was they found us. They used a very high-profile global advisor to help them. It was going to be a recommended offer to shareholders, and it was a nine-figure amount. So it was quite a big deal in comparison to some of the other transactions that I've done. I had a very good relationship with the other point person on the other side of the deal. So we worked really closely together. I think you asked the question, why would deals fall over? I think making sure again that any information that you give has been sensitized and stress tested before it goes anywhere, and making sure it fits with the information that you've already given in terms
Mm.
of negotiating a price, for example. And that should be the case, because if you've artificially inflated the value of your organization, that will get found out very quickly in due diligence. So I think being confident, being ready to go through a 3 or 6 month process, for example, where you are confident yourselves of the information, that you're not going to be let down on any forecasting. So if you're going through a 3 to 6 month process and you're continually saying, well, we missed the last month, we missed the last quarter in comparison to the information that you've shared earlier, that begins to damage the credibility. So I think
Mm.
keeping a real handle on the information. I think being truthful as well. If people have got a good scope of due diligence on your organization, financial, commercial, environmental, intellectual property, taxation, and I think it's important to be really truthful in all of that. It will get found out in doing due diligence. I'll give you an example. This might make you smile. This was when I was a buyer as a CFO, and we had identified uh, an acquisition that was actually would have been transformational for our organization. It was for us. It would have been a reverse takeover. It was being handled by, as an advisor, one of the what is now the major four firms of corporate finance accounting firms. And it was a great business for us to acquire. It was privately owned, and we had established a good relationship with not just the advisors, but the principals as well. We seem to have structured a price for the organization, which was a cash and shares price. We did some of our own personal due diligence. This is way before Google, where you could do various checks. So this wasn't social media. We thought we'd just make sure we'd do a little bit of credibility checks on the management team. And one of the things that we found out was that the CEO of this organization had relatively recently served a jail sentence for fraud. And so this was quite an interesting one for us. It was
Mm.
also 6 years, practically speaking, as well, perhaps less interesting, but fairly important for us. There were 6 years of corporation tax returns outstanding and not agreed. So we had two major issues there. The tax returns, I was actually astonished that they hadn't resolved that before becoming available to purchase as an organization. And but the jaws hit the floor when we said, actually, we've just done a little bit of due diligence. We haven't worked really hard to get this information, but we really don't think we can have your CEO as part of our organization. And actually, we're very surprised that you didn't know about that when selling this organization. In actual fact, fast forward 12 months, we said, notwithstanding that, we really do like the business and the business model. If you sort the management issue out, if you sort out the corporation tax returns for the last 6 years and come back to us, we may well still be interested. Fast forward another 6 months, we did execute a reverse takeover. We did pay the price for the organization. The numbers did stack up, and it was a really successful acquisition. So there were a few bumps in the road to establish that. So I think just being credible internally. Have we thought about, somebody's going to ask us, for example, about intellectual property? Have we got everything in place to say that we've got trademarks, we've got patents, all of those things? Have we established, for example, whether there are any change of control clauses in lending agreements, with customer agreements, that we are obliged to reveal to not just them, but also a potential buyer as well? So I think you can do vendor due diligence. So part of the process may well be, we're effectively going to look at ourselves first, and we're going to prepare vendor due diligence, which probably won't stop the buyer from doing their own, but it can actually stop some of those issues becoming a later issue further down the line in the process. And it's an opportunity to be self-critical in producing any kind of process.
So I always find it really hard to explain to people why they should choose ITAS as their financial transformation or Sage partner. So rather than me tell you how awesome we are, I'm going to let our customers do it.
So we decided to go with ITAS because when we were looking for a partner, we felt that they not only took the time to understand our business and they knew the needs of everyone on the team or everyone that would be using the system, but they also were very transparent in kind of what they could do, what they couldn't do. And prior to having us, sign anything or make any agreements, they held meetings with us to walk them through our processes and our business, so that they really understood everything that would need to be done and give us realistic timelines as well. And another thing was, because we were so new and we didn't have a current system going, we were looking for something that we could implement rather quickly, but also do it correctly. And we felt that ITAS would be able to achieve both of those in terms of, understanding our business and implementing it how we wanted it, but also doing it in our rather quick timeline.
And you've mentioned a few categories of due diligence, like the areas of focus. You mentioned intellectual property. Just talk us through what those different areas of due diligence that you would expect a strong or a good buyer to ask about during the process.
Yeah, I think potentially the financial information might even be the most straightforward. And again, but I'd just offer that caution around whatever the financial information says. they're going to form a judgment as to how credible you are as a management team in producing a forecast. And everybody wants to know what the next 1, 2, 3, maybe even year 4 and year 5 looks like. If you can't forecast the last 6 months or the last year accurately, then they're going to form a judgment as to whether they can place any credibility on the next 3 to 5 years. Equally important, particularly now, are the areas of intellectual property, patents, trademarks, anything that could set yourself up as the unicorn in your sector that you own and is unique to you. I would also suggest lots of people will do environmental due diligence now, simply because a lot of their own, if they're raising money themselves to acquire you, their own lenders and their own shareholders are likely to ask questions around environmental, social, and corporate governance. They're likely to ask, does it fit into the model that we want with you as the potential buyer? So they're likely to ask about ESG. They're likely to ask about ERP systems and IT. Is it credible? Is it going to fall over? Are you going to lose support because you haven't updated all of your systems to the latest support level? So they're likely to ask about ERP and ICT as well. They're likely to ask about commercial agreements as well. They're likely to ask, does anything change? Are there any changes of control, contract clauses in agreements that you have? Are there any changes of control with lenders? So the lenders to the target company, do they effectively have a veto because they have a change of ownership clause in there? So all of those areas around the business model itself, whether an organization is unionized, for example, what kind of input do colleagues have within an organization? So all of those areas to think about before you even get to the stage of signing on the dotted line and the transaction being executed.
And there's a lot within that, isn't there, in terms of the detail? And you've mentioned legal as well as a big one. So, like looking at the contracts between customers and suppliers, or is there a bigger piece within that?
A big piece, and for those people who've been involved in acquisitions and disposals, the sale and purchase agreement could well be something that used to take the depth of a telephone directory, and the easy part again is the price, the form of the compensation. The more difficult parts are the ones that could be, for example, let's call them the showstoppers. What and I was a big fan, and my chief executive in particular, one organization, was a very big fan of addressing the showstoppers up front. Don't waste any time doing all of the less interesting negotiation and due diligence. If you get to the stage where you have a showstopper, what could stop the deal? You mentioned legals there. The other things that are really, really important in selling a business are to establish up front the people who own the business, and indeed the management who may not even own the business, but the ownership may be reliant upon, what warranties and indemnities are going to be asked for by the buyer. And let me explain what those warranties and indemnities are. The buyer is going to ask you whether you've anything to disclose about this business. Again, just like selling a house, for example, the buyer will ask you, is the roof in good condition? And you may well say, yeah, the roof's in good condition. But by the way, you make a disclosure against that, which is, but you need to look right over to the western side of my roof because there's a ginormous hole in it. And you've done your job then uh, as a seller by saying, I've told you about that big hole. Don't come back to me in 12 months and say there's a hole in the roof because I've told you about that. And it's the same policy to apply when selling the business. They're going to ask you things like, have you got any good reason to tell us that your customers may not renew the agreements? And that's not actually saying, can you guarantee your customer will take the same level of revenue for the next 5 years, they're asking you whether there's any trouble going on. Have you been served notice, for example? They're going to want to know that, and it's your duty as a seller to reveal that information as well. So that discussion around, are you going to want warranties and indemnities? The answer most probably is yes. And then to what extent? Because there's a level of threshold involved in that. Um, at what point does it become worthwhile telling people? That's usually a financial threshold. You can make disclosures against it. I've been in a situation buying a business where there were very late disclosures, and some of them were quite important ones as well. And that gives you a sense of they're not telling us everything. So when 2 days before the transaction is about to complete and somebody tells you, oh, by the way, I've not told you this before, but the FD resigned 3 weeks ago and they're leaving next week. Absolute factual truth that happened. And then they also tell you at the same time, and by the way, we think we've got a bad debt in the balance sheet. And also, by the way, we've got X £100,000 worth of obsolete stock. At that point, there's some big red flags going up and saying, you're telling us now because you think we're so far down the process that we're not going to pull out. So really important to get those debates around warranties, indemnities, the legals, and also the transaction. How are you going to execute the transaction? Because lots of deals, I'm sure, will take the form of earn-out deals. So you're basing your ultimate sale price on the performance in the future. And a really good question to ask as a buyer is, do you believe your forecasts going forward in years 1, 2, and 3, for example? And it puts the seller in a really difficult position. The seller can say, absolutely, I agree with the forecast in years 1, 2, and 3. Here's the financial information. We've all prepared it as a management team. And if I'm the buyer, I can then say perfectly reasonably, well, you've got no problem in putting half of that consideration as an earnout then, because you just told me that you really, really believe in your forecast. The alternative answer is, I'm not quite sure about the forecast. It's really aggressive. In which case, I look at the forecast and say, well, what you're really saying is you're not going to hit that forecast. So it's a really challenging question, and there's no easy way out of that. And it is just that negotiation between how much consideration do you want up front? How much is part of the future? And is there a trade-off in negotiating that? And I've done those kinds of deals, and they are effectively a trade-off, but it is perhaps more of an opportunity to think about how those negotiations are taking place. Are they good-natured? Are they cordial yet challenging? Or is it very aggressive? Let's go back to legals again. Are the buyers managing their lawyers correctly, or are the lawyers taking control and using it as an ego trip to try and beat up the lawyers on the other side, which is again another amber stroke red warning flag. So many things to consider. And the other thing to perhaps mention as well, in disposals and indeed acquisitions, it feels to me, having done 25 plus transactions in my career as a CFO, they all take the same time. Whether you're spending 100 million or 1 million, it seems to take exactly the same length of time. So there's no kind of step function that says the bigger the deal, the longer it takes. In fact, potentially the opposite. Some of the smaller deals I've done have been the most challenging, the longest, and the most awkward. And in fact, the very largest deal I ever got involved with was the smoothest by a long, long way. Everybody, with the due diligence was great, the management was great, culture was really good, challenging, and there was an earnout as well, but it was really, really well put together by everybody, and it worked very well. And post acquisition, it was very successful as well.
And you've mentioned a few times sort of structuring the deal, the option for shares, the option for earnouts. Tell us a little bit about some of the the options on the table in terms of deal structure, and I guess what you as a CFO need to think about to decide whether it's the right deal for your organization.
I think as a CFO, I think it will depend on whether you're part of the selling ownership or whether you are the hired help, as it were.
Yeah.
I think if you're the hired help, then I think it's really up to you to be a really challenging, confident to the shareholders. And you can be that internal sense of normality. And again, recognizing that for a good many people, it really might be what they worked their whole lives for in realizing value out of their organization. I won't mention the name of this particular company, but it was a business that was sold at too high a level. And you could argue that did it matter? Because the sellers, and I know that there were 11 shareholders involved in this company, and I wasn't a shareholder in this particular organization, but I was the CFO. This was a business that sold at a very high value in terms of price earnings ratio, in terms of multiple of EBITDA. Now, that was great on day one, on day of execution. 2 years down the line, when the consideration was being compared with the speed of growth of the business, which was not quite as accelerated as perhaps it could have been, there were some challenges then in saying, well, we paid top dollar for an organization and your performance is not quite top dollar. So we've got a problem with that. How did it manifest itself? Part of the consideration was in tradable shares. And the fact that the business was not performing at the expected level meant that the share price came down. And therefore, it did ultimately have an impact on the consideration. So I think things to consider as the CFO, being rational and level-headed and actually just thinking about the future. What's going to happen in 2 or 3 years' time, particularly if there's an element of earnout? Will it damage the relationship if you're trying to maximize everything on day one of the transaction? Other things to think about, again, what are the expectations of the buyer? So understanding and being very, very clear, what do they expect financially, commercially? Do they accept the fact that some of your customers may churn, for example, or are they expecting you to have all of your customers still in place in 3 years' time at the same level that you're currently trading at? What are the expectations of management? Are they going to lock you in, for example, in terms of part of the deal being the fact that the whole of the management team stays together? That might suit some of the management team and or shareholders if they're one and the same. It might not suit some of the other management team to be told, basically, we've got some handcuffs on you and you having to stay. I did one transaction where I had to stay a minimum of 18 months. This was being acquired by a big US company. And I didn't particularly want to do that. It was okay. It was interesting, but it wasn't something that I planned on spending a day longer than 18 months in that organization. It was interesting, but the expectations of the buyer in a whole series of areas, I think, are fairly important to, again, make sure all of that information is on the table straight away.
Yeah, so understand, like, because that's a really good point. If you as a CFO aren't willing to stay on or wanting to stay on, you don't want to be a detriment to that deal as part of that process. Certainly not handing in your notice 3 weeks before the deal is due to be struck, as you've had in a different scenario.
Yeah.
So, and I guess, and I can't believe how quickly we've gone through the time, Jeremy, just asking questions already. So, when you I guess where are the other sort of key areas where things can go wrong when it comes to being acquired? And I'm very much looking from this, from where
Mm.
can you fall over, whether, in trying to do the right thing for the business?
I think one thing that we haven't mentioned so far, and I think is really worth mentioning, is if you're in a sale process, um, particularly where there's an advisor involved, and I
Mm,
will give you an example. Um, your position in the marketplace is really, really important. So, for example, if you had appointed an advisor to maximize the potential value and effectively run an auction process for your organization, you might be requested to effectively give a lot of information in an investment memorandum, which is going to your competitors. So,
mm,
and that's a real challenge. So you're balancing some of these competitors might well be my best buyers, but if this doesn't go ahead, I'm giving them a lot of information about my organization. And I will give you an example in that in in a group of companies, we had one particular division, and this division was a business which had any number of competitors all over Europe, and we were about to appoint an advisor, and that particular advisor, who would be a very well-known advisor, quite reasonably said, well, to generate maximum value, we're going to create an investment memorandum. You're going to put all of your information in there, including effectively state secrets about how you run your operation. And then we're going to approach private equity, venture capital, and the competition as well, your competitors. And we said, hang on a minute, we're not quite sure about that because we know who the competition is, as you would expect, and we're not quite sure that ultimately this isn't going to be a fishing expedition where people present themselves as being a credible buyer, have demonstrated proof of funds, take all of the information, and then do nothing with it other than furnish their own business. And we actually took the view that the most likely buyer was going to be a management buyout backed by venture capital and private equity. And we took a view on that, and we actually ended up preparing our own investment memorandum. I wrote it. I effectively almost copied and pasted the style of an investment memorandum, produced it, and then we did our own sale process to venture capital and private equity. And ultimately, we sold it to private equity, to a Dutch private equity business as well, because the major element of this business was actually in the Netherlands. So lots again to think about in terms of that kind of preparation and
mm.
making available information to the marketplace that your competitors could well utilize. The alternative to that is you run a process where you effectively don't give any interesting information over, and
Mm.
that has its limitations as well because the buyer is not really working on anything that's useful information. It's very generic information. So lots of challenges again.
And you've mentioned proof of funds a few times. So,
Mm.
what sorts of questions should you be asking the potential buyer to establish whether they are a viable buyer? How do you approach that when you're selling or disposing of an organization?
Very much as you would when thinking of disposing something on a domestic basis, I think, as
Mm.
well. If you were selling your house, let's go back to that house trading analogy. I'd like to know that there's a mortgage offer in place if somebody asks about making an offer for a
Yep.
property. I'd like them to say, I have a decision in principle from a mortgage provider. In the same way, I'd like them to say, if you have cash, fantastic position if your buyer is buying in cash. Well, show me the color of your money. We hopefully have signed a non-disclosure agreement by this stage. That's another red flag if you can't get that done within 48 hours, because if
Yeah.
you have trouble negotiating that, think how difficult it will be to go into the rest of the process. So if you're buying in cash, I'd like to see that you've got a bank statement with whatever number on the bank statement that you need. I'd
Mm.
like to be, I've done my own due diligence, I hope, by this stage on the potential buyer by analyzing what information they have at company's house. If you're lending, if you're borrowing money, I'd like to see some kind of confirmation from the buyer's lenders that they have the ability to lend the buyer the right amount of funding. If they're raising equity, and I've been in this situation again, I'm looking at the buyer's advisors to be able again to give me some kind of confirmation that we think it's feasible to raise equity as part of the consideration to buy this organization. And if you can stack all those up with the intention, then you've got yourselves the potential of a transaction.
And you mentioned shares as an option for buying and selling organizations. What's some of the considerations that need to go into if you're going to do, is it share exchange you mentioned?
Share for share exchange. So let's take an example. You're selling your business for £1 million, and somebody says, "Well, I'll give you £500,000 in cash, but you can have £500,000 worth of my company's shares." So at that point, I'm fairly fixed on the £500,000 in cash. That would appear to be fairly straightforward. Color of your money, I get £500,000 in cash. However, somebody's just offered me £500,000 worth of shares in their own company, for example. So at this point, I'm into a whole new exercise because I might not know much about your company. One, what it's worth, what it's going to be worth in 3 years' time, what's the class of share that I'm being offered, what are my rights on the class of share that I'm being offered. So, for example, am I being offered exactly the same class of share as the people who are making the offer? Or am I getting palmed off, for example, with B or C class shares, which might be perfectly valuable, but might not give me decision-making rights? So what kind of share am I being offered? I suppose the easiest one would be, well, we'll give you £500,000 worth of shares in ABC PLC. There's the price in the paper. You can pick up the Financial Times and see the price in the newspaper every morning. However, what happens if the market dies for no other reason than the market goes down? Have a look at everybody's pension funds when COVID hit 4.5 years ago, and all the markets went down. So all of a sudden, I might have said, great, I'll have £500,000 worth of shares in ABC PLC, and a war happens, an election happens, a pandemic happens, and all of a sudden, that £500,000 might be worth 230. Now, I have to rationalize that and work out whether that's a good deal in the long term. So lots and lots to think about. It involves and introduces another variable into the transaction. And again, think about it in buying a house. Somebody comes along and says, your house is worth £100,000. I'll give you 50,000 in cash, and I'll give you 50,000 in some other asset that you don't know much about. What are you going to do if you're selling your house? I'm thinking I'll have the cash up front, please. But you never know. You could do really well out of that. You could do an assessment that the shares you are being offered are undervalued. And in actual fact, that £500,000 extra in shares ultimately might be worth a lot more. But you are introducing another variable to the transaction. And again, your advisors can really offer you good value in helping you decide whether it's a good decision to take or not through strategy to be able to present. Go back to that, what's going in the data room, making sure that that is the data which everybody's agreed to. Make sure your business is ready for sale, in effect. Make sure that there's a proper information flow, that as the CFO you're in charge of. Try to manage the situation that there's no hiccups in the transaction process. We all know it's difficult to manage that, but wouldn't it be great if you go through the process and you hit your numbers? So be very careful about when you get into that process about making a short-term forecast. If you can't forecast the next 3 months, what are the chances that you can forecast the next 3 to 5 years? So try to make sure that you're not going to trip yourself up in that process. I'd also be looking about the culture match and making sure that we all know what the intentions are for the business going forward. And that can just make people be more open with each other as well. So lots to think about, but maintaining control of the data, I think, is a really good starting point, and making sure that you're speaking with one language when you speak with the buyer.
Well, thank you so much, Jeremy, for sharing that insight. And to our listeners, if there is anything that I missed in terms of questions, I may have convinced Jeremy to pop back on for a few more times. So please send me through your questions and I will add them to my ever-growing list. I think the more of these conversations we have, the more questions that come out. So thank you so much, Jeremy, for joining me. And if people want to learn more about you, the CFO coaching that you do, where is the best place to find you?
Best place is via my website, which is Clarendon Coaching, all one word, clarendoncoaching.com. My email is jeremy.earnshaw@clarendoncoaching.com, and I'm quite easily accessible and findable on LinkedIn, and I'm quite active on LinkedIn as well. Not all to do with business, sometimes to do with football and particularly cricket as well.
Well, if you're interested in the role of the CFO, cricket or football, we'll put the links in the show notes after this. So thank you so much, Jeremy. And thank you to our listeners as well. We'll hope to see you next time on the CFO 4.0 podcast.
Hey Google, what's the best accounting software for my business? Give it a couple of years, and I bet you she'll be able to answer you pretty accurately. But for now, it's still one of the few questions Google can't give you an answer for. But we can. Take our free quiz and find out which Sage product is the right fit for your business. Just head to itassolutions.co.uk.